hold, where we take people through investing basics and deep dive into certain aspects of basically managing your finances. So we hope that by the end of each series, so it usually runs across a couple of weeks, you'll be equipped with the knowledge to get started on your own investing journey, or if you're already invested, to have more confidence to continue on the journey, especially given that most of us here are investing to prepare ourselves for long-term goals like retirement, potentially buying a house. Yeah, so to start, let me do a brief introduction of Stashaway. For those who may not have heard of us, we were founded in Singapore in 2016, and we have since expanded to 4 other geographies. Now, this includes Malaysia, Dubai, Hong Kong, as well as Thailand. So if you're joining us from any one of these countries, hello, good evening. And we're licensed in all these 5 jurisdictions. As of 2021, we have $1 billion of assets under management. Some of our backers include some of the biggest names in venture cap. We have Sequoia, Fidelity, Square Peg, as well as Hamilton Lane. And we've also received numerous accolades over the years, with 2 of the more recent ones being named as one of APEC's high growth companies by Financial Times and amongst the top 200 global fintech companies by CNBC. We are a digital first company. Sorry, let me just go back my slide. We are a digital first company. So the image that you see on the left of the 2 mobiles is an actual look of our app. So as you can see, we try to make it as clean and as simple for our users. So if you have not already checked this out, feel free to download the app of any of the app store that you're currently using and just play around the app. It's completely free to join. Yeah, so it's non-committal as well. Now, over the years, we have released a good selection of products, as you can see here on the screen. This is what's currently available for our users here in Singapore, from cash management that give you high yield for your excess cash, to manage portfolios so you can take the cognitive load off of investing. So if you recall, or if you had joined us last week, the one thing that I could not stress enough was we're in this day and age where we have technology at our fingertips, and we should definitely leverage technology. So this is where Stashaway comes in to help you take the cognitive load of investing. And we also have alternatives, private markets. This currently is only available to accredited investors in Singapore. If you can see the third column there, thematics, that's actually something that I'm going to be talking a little bit about today. But if you'd like to find out more about our products, if you'd like to talk to someone who can maybe help walk you through in more detail, please feel free to reach out to our team at support@stashaway.com. Now, this is the agenda for today. We're going to be running through some investing basic just to get everyone up to the same level. Then we'll run through the basics of ETFs, how we can actually build an ETF portfolio, and then we'll run through some long-term investing strategies. Now, this includes, as I mentioned earlier on, I'll be talking a little bit more about thematics. So stay tuned if that's something that you'd be interested to learn more about this week. Now, just a quick recap before we start. I just want to kind of run through what we ran through in the first Master Your Finances webinar last week. Before I continue on, if anyone has any questions at any point in time, we are actually live on 2 platforms. We're live on Zoom for those joining us on Zoom, and we're also live on Stashaway's YouTube channel. So if you're currently on Zoom, please feel free to use the Q&A chat box function that you might see. If you don't see it on your screen, you might have to click more, I believe, the three dots, you have to click more. And you would have the Q&A box, and feel free to ask any questions about our products, portfolios. For those of our friends on YouTube, please feel free to use the YouTube chat box that you see on the right. I have some of my colleagues in the background who's going to be helping me answer some questions, but I will also allocate time at the end to answer some burning questions that you may have. Now, quick recap of last week's webinar. There were 5 main takeaways from last week. Now, before you start investing, very, very important for you to determine your risk tolerance, how much risk you can stomach, or you think you can stomach, and then think about what your financial goals are. Now, this can be anything from buying a house in the next couple of years. Maybe you have travel plans in the next 3 to 6 months, perhaps retirement in the next 10, 20, 30 years. Once you have once you have that down, you can start investing in a diversified portfolio across different asset classes, stocks, bonds, commodities, and a small portion of cash. Thirdly, the one thing you should not take lightly are fees, the fees that you are paying. Next is investing is only successful if you build good habits and have good mindset. So make sure you dollar cost average in, constantly review and rebalance your portfolios, and most importantly, maintain a long-term mindset. Last but not least, the most important thing is to start investing. So regardless of where you are, in your life journey, regardless of how old you are, it's never too late. The most important thing is you start. So I'll run through actually some numbers later on. Hopefully it will give you more clarity as to why it's so important to start today. All right. So before I get to the main topic, quick question to the floor. Could I trouble everyone? If you could just whip out your phone, give this a scan, and let me know if it's not working. It should be working for everyone. Just give this a scan. We would like to actually understand a little bit more about where you are currently in investing, right? So if you are someone who has not started investing, what is currently, holding you back from taking that first move? For those who have already started investing, the question right now is, what do you remember being one of the scariest thing that was actually hindering you when you started investing? So let me just check that this is working. You can scan this QR code. Otherwise, feel free to go to slido.com, and then the code is 3861417. Let me just check. Yeah, so I believe it is already working. So yeah, I'll just kind of put this on for another 5 seconds. All right, so I see a couple of answers coming in. Fear, lack of knowledge, busy, not having enough capital, price too high, market is too volatile. So, I mean, some very interesting um, reasons here, and fears. And hopefully by the end of today, busy. That's why you have stash away. Okay, so yeah, so I mean, really, really, really good answers here. I hopefully by the end of today's session, you would be a little bit more comfortable, and I'll essentially also help you um, not entirely overcome, but at least make sense of some of these fears that you currently have. So thank you so much, everyone, for participating. This will keep running throughout, so just feel free to just leave it on, and as we go, if you think of something else, please feel free to add it on to the word cloud. Now, um, as I mentioned early on, I want to run through some basics of investing just so that we can get everyone up to speed. So, what is investing? Now, investing is when you can actually allocate resources with the expectations of generating income or profit over time. Now, when I recapped what was shared in the webinar last week, I mentioned the aspect of investing in a diversified portfolio across different asset classes. Depending on the asset that you choose to invest in, you will be taking on different risk. So what you see in front of you are the different assets and the common risk that comes with investing in them. So to the left, you have the asset with the lowest risk, which is essentially cash. So if you hold cash in a bank account, it's essentially risk-free to a certain extent. And to the right, you have the asset with the highest risk, which is small cap equities. In the columns that you see, the different colors is the type of risk premium. Now, what are risk premiums? A risk premium is actually the extra return that you as an investor expect to receive for taking on an additional risk with an investment. So think of it, if I can simplify it for you, think of it like this. If you have two options, one that is safer and one that is riskier, you would naturally want some extra compensation for choosing the riskier option. The extra compensation that you're expecting is essentially the risk premium. Just to put it very simply, I'm simplifying it, but that's probably one of the easiest way to help you understand what a risk premium is. Here you actually see a pyramid of risk. Now, by investing in the riskier option, you also have the potential to experience a larger growth. But with that, it also comes with a potential larger downside. So that's why it's incredibly important for you to factor in your risk tolerance, how much risk you are comfortable taking before deciding on the assets that you want to invest in. Now, that's very, very important. I will speak a little bit more about that. I've touched on it last week, but I will be basically repeating myself again later today because we do wholeheartedly believe that understanding your risk is one of the key aspects to ensuring that you invest successfully. Now, if you were with us last week, the next slide will actually look very familiar to you. But just again, to run through this very quickly, when we talk about risks, there are two core concepts that people often get confused with: risk appetite and risk tolerance. Now, these two things are very different, but often get confused by a lot of people. Now, first things first, a risk appetite is someone who says, I am willing to invest in risky assets. The key word here is willing, meaning I want to. Whether or not I can is a different story, but because of my age, because I feel like I have the capacity, I want to do it. Tolerance is more the fact that I cannot accept risks that will cause my portfolio to decline more than a certain percentage. Now, as I mentioned earlier on, tolerance is way more important than your willingness when it comes to risk taking. People are usually willing to take higher risks for the potential of higher return, because there is in the Dutch, high risk equals high returns. So that's true to a certain extent. But then when markets move against their expectations, they find that they're either unable to sleep well, they get anxiety. So make sure that you are basically essentially taking risks and investing in assets that is within your comfort level. So that's something that is most important. Your risk tolerance is way more important than your risk appetite. Make sure to keep that in mind. Now, if we want to invest in public markets, these are three of the more popular options. So you can either invest in individual stocks, unit trusts, that's very popular in this region, or via exchange traded funds or ETFs. So ETFs is a star, but let me run through it one by one. So when we talk about individual stocks, this is when basically you take position in a specific company by buying the share of that specific company. So as an example, let's say you really like Apple as a company. So you decide to buy a share of the company to become an owner, quote unquote. So you have a direct participation in the company's growth as well as decisions. Because when I say decisions, that's also because, as a shareholder, you can technically attend and vote in their shareholder meeting. You can vote on certain decisions, right? However, there are pros and cons to this. Pros is that by having a single share exposure, you potentially are able to get good returns. You probably experience, higher growth. However, you should not just buy shares because your friend told you to. You need to ensure you read up and you make that buying decision after doing research on your own and make sure that you're comfortable with the risk that you're taking. Another way to gain access to public markets, as I mentioned, which is very popular in this region, is actually unit trust. Now, unit trust it's generally a collective invest fund where you as an investor, you invest a certain amount to buy quote unquote units of said fund. It's usually, generally actively managed by fund managers. However, when it's actively managed, it does come with higher fees. And usually also there's quite a bit of T&Cs. And there can be high minimums as well. So example, to invest in this, you need a minimum of maybe $5,000, $10,000. So those are some of the T&Cs and I guess the cons of investing in unit trusts. Now, next we have the star of our webinar today, ETFs. Now, ETFs are kind of the best of both worlds between stocks as well as unit trusts. So they allow you diversification. And just by buying one ETF, you have exposure to a whole bunch of sectors or securities. So let's use one of the more popular ETFs out there, S&P 500 as an example. If you buy one share or one ETF, or I guess if you were to log onto a brokerage platform or whatever the case may be, and you were to buy into the S&P 500 today, essentially you're giving yourself exposure to the top 500 companies in the US. So what are the benefits of ETFs, right? Number one, it's much lower in costs compared to unit trusts. However, if you're someone who likes to trade, you could essentially incur trading costs, much like stocks I'll run through ETFs shortly. Just want to take a breather here and just check in to see that everyone's okay. Just as a reminder for those who have just joined us, we are live on two platforms, Zoom as well as YouTube. If you have any questions, please feel free, if you're on Zoom, to use the Q&A chat function. If you are on YouTube, please feel free to use the chat box at the side. My colleague is at the background helping me with some of the questions, and I'll also make sure to basically leave time at the end to answer some of the questions that you may have. Okay, now let's move on. What are ETFs? Now, ETFs are an acronym. They are an acronym for exchange traded funds, and they are basically a pooled investment that tracks a basket of securities. Now, the underlying of ETFs are usually a collection of securities, or maybe potentially bonds. Now, as I alluded to earlier, ETF basically offers you the best of both worlds between unit trusts and individual stocks. They are listed like stocks on exchanges, so you can actually buy them if you currently have a brokerage platform, and you can sell them when the markets are open at real-time prices. Unlike unit trusts, right? Unit trusts, usually you have to go through your fund manager. There's usually a time lag, whereas like buying and selling ETFs is a lot more straightforward in that sense. They're also much lower in costs compared to unit trusts and can potentially be more diversified. So what are the advantages of ETF? If I may summarize, first, they're low cost. They're way cheaper than traditional funds. So more of your money keeps growing, right? Because more of your money is actually being invested. Secondly, they actually let you diversify across sectors and securities. So things, stocks, bonds, potentially when we talk about sectors, we talk about tech, healthcare, even global markets as an example, all in one ETF. So you spread your risk like a pro. Yeah. Third, they're accessible as well as flexible. So as I mentioned, they trade on exchanges as long as the exchange is open. So you can buy and sell when it's open, unlike funds that lock you in usually until day's end. Plus, they're also transparent. So essentially, you can see exactly what's inside daily, no guesswork about what you own. And best of all, there's usually no minimum investment. So you start with whatever you've got, even $10. Now you are able to buy it in a fractionalized manner. So ETFs actually make investing feel like a cheat code. They're affordable, they are diverse, and they're built for your control to a certain extent. So they are the perfect tool to build wealth steadily as well as confidently. There was someone who had just now posted, what's something holding them back. They said busy. I mean, just buy into the S&P 500. I think that's actually a good way for you to grow your cash. And you mentioned you're busy, so this is one of the ways where you can actually sort of take the cognitive load of investing. But I'll get to that slightly later. Now, what are the various types of ETFs? So there are a lot that you can actually choose from. If you like one that tracks, large cap companies, you want one that's more actively managed than usual. You want something that gives you exposure to commodities. You'll be able to find whatever you want, your exposure to be. Again, I'll take a pause here for everyone to digest this and tie back to my points of ETFs being a good way to gain exposure to multiple companies at once, while also allowing you to diversify across sectors. Now, as we continue to dive deeper into ETFs, they seem to have more in common with unit trusts than they do with individual stocks. So here's a look at their key differences, right? Much of the benefits of ETFs I mentioned in the previous slides are strengths when we compare them to unit trusts. They're lower in cost, they're way more accessible and liquid, and they have fairly low minimum investments, and it's generally more passively managed compared to unit trusts. Now that you have a sense of what ETFs are, let's think about building a portfolio. How do you actually envision what a diversified ETF portfolio should look like, right? Now, first of all, why ETF and what's the fuss? Why do people like them so much? For a start, there is actually nothing more fulfilling than finding a good publicly traded company, investing in it, and watching your investment continue to go up to the right as time progresses. Sounds simple enough. But in reality, there are actually various factors that actually make it very, very hard. So consistently picking a winner is really not an easy task. And exposure to, these can be expensive from a share price standpoint, as well as costs that may add up. So lucky for us, ETFs do exist. Now, as Warren Buffett once said, I don't know if you guys have heard of Warren Buffett, but he's quite famous. The trick isn't really to pick the right company, but it's to buy all the key companies through the S&P 500 and to do it consistently. So he's touching on 2 points here. The one thing is, take the cognitive load trying to think, okay, which company should I buy? Invest in one ETF that gives you exposure to multiple companies, so you're at least diversified to a certain extent. And when he says the trick is to do it consistently, he means also dollar cost averaging. So regardless of market volatility, regardless of where the market is today, where the market could be tomorrow, you just take a disciplined approach, potentially set up an e-giro or direct debit from your bank account to whatever platform that you're currently using to consistently buy this specific ETF or a group of ETFs or specific portfolios consistently, regardless of again where the market is moving. And you know what, the person in 10 years, in 10, 20 years, the future you would actually thank you today. So yeah. Now, when we talk about building a diversified portfolio, it should look something like this. This is an example that's of one of Stashaway's own diversified portfolio. Just now, as you saw in the chart earlier on, this is actually a general investing by StashAway portfolio. So as you can see, even within each segment, despite us actually breaking it up into specific sectors, within the sectors, we also have diversity in ETFs, right? Just in order to ensure that you get different exposures. And then, of course, as I mentioned early on, you need to ensure you know what your risk tolerance is. So depending on where you are on the spectrum, conservative to moderate to aggressive, your portfolios should look different. So as you can see, at the bottom, your higher risk portfolios would have higher exposure to risky assets, which are like stocks. Your low risk portfolios would have exposure to steady assets like bonds. But regardless of where you are on the risk spectrum, you should have exposure to different assets in a portfolio. Now, why is this so important? It's because when you have different exposure to different assets, it actually helps to balance out the volatility of the market, since technically all assets actually don't move in the same direction. Now, returns for diversified portfolios, as you can see, are also not boring. At the bottom, you can see the performance of these diversified portfolios in US dollars in 2024. Sorry, I know I put SGD there, but it's meant to be in USD. Now, it's also because most of the ETFs in our portfolio are denominated in US dollars. So the return should actually be in US dollars. Now, ETFs are great. I've talked about everything good about ETFs, but what are some of the common mistakes that we can make? Or rather, you should avoid. So much like trading stocks, it can be very tempting to want to try to time the market, which then potentially leads to overtrading, which then increases your costs and helps you realize losses, or makes you realize losses rather. So you should also know what you're investing in. That's very, very important. Be sure to be comfortable with the ETF that you're about to be investing in. What is it giving you exposure to? Are you comfortable with the underlying assets? Those are actually very, very important questions that you should be asking yourself when you're looking at a specific ETF. Also ensure that you don't choose investments just based on past performance, right? I think you've heard this quite a fair bit, that past performance is not indicative of any future returns, and it's really true. We're not just saying it for the sake of saying it, but it's really, really true. So having a high exposure to one specific ETF is also not ideal. You should be diversified, as I've showed you in a couple of slides back. Let me just go back. So as an example, as I mentioned, even if you want to just get exposure to US equities, you got to make sure that you're exposed to potentially different sectors. So having just one specific ETF, that's not ideal. You should definitely expose yourself to different sectors within a specific segment. And last but not least, one of the common things we should avoid is don't ignore currency risks, especially if you're investing in ETFs that will be giving you exposure to other global assets. So that's very important. So make sure that you keep this in mind when you're investing in ETFs, when you're trying to build your own portfolio. Very quickly, I'd like to run through the concept of core as well as satellite portfolios. Now, core portfolios are the ones that you have that are passively managed. So they usually contain safer assets like, again, ETFs, and they are lower in risk assets for more longer term investing. So they tend to be, a lot steadier in that sense. Satellites are the ones that are more actively managed. It could be thematics, as I mentioned. It could be any sort of alternative investing. Someone just now wrote crypto. That could be part of your satellite. It should never be part of your core, just generally because of how much riskier it is. I think the long shot of it is, if you can sense a pattern, that for your core portfolios, they are generally a lot more fundamentally sound, perhaps sectors or segments. Whereas for satellite, you can afford to maybe have a smaller portion of your overall portfolio invested in higher risk assets. Now, here is a little guideline as to the kind of assets you might want to have in each category. So as I mentioned before, diversification is important. So you can have both and have a healthy split to ensure that your returns remain steady. Now, the larger chunk of your portfolio would be your core strategy, which I mentioned earlier. So that should take up anywhere from 70 to 80% of your portfolio, making up of potentially stable assets with steady returns. You can take slightly higher risk, but obviously you would take them in more fundamentally sound, perhaps companies, assets, or sectors. When we look at the satellite portfolios, the remaining 20 to 30%, this can be a more high-risk assets, right? So these active managed assets are essentially your alternative investments. As I mentioned just now, with potentially crypto, potentially, any sort of private markets like angel investing, if you are an angel investor, because that's generally also very high risk, versus like in your core portfolio, as I mentioned, maybe you have dividend yielding stocks, low cost ETFs. So you can kind of see the difference here between what should make up your core portfolio and what should make up your satellite portfolio. Now, part of the high risk assets that you can actually add in your satellite, this actually includes thematic ETFs, the one that I mentioned earlier on. And generally, the reason why we also have the concept of, or why we might have a satellite portfolio is because this actually serves to enhance your return, but because of the higher downside risk, it makes up a smaller portion of your portfolio compared to the assets in your core portfolio. So definitely keep this in mind when you're trying to build your asset mix or where you're thinking about building your overall portfolio for yourself. Now, let's think about some long-term success strategies. A lot of times when we want to invest, we're always waiting for that right time, right? What is the right time? When do I need to just deploy my funds to catch that right price? Markets seem to be moving lower. I don't want to invest now because I don't want to be catching a falling knife. The truth is, no one can actually predict the market. No one knows where the market is going or where the markets will go. If someone claims they do, please also introduce them to me because I would like to retire. But the reality is that no one can actually tell where the market's going to move. No one can actually predict what's going to happen tomorrow. I think that's quite evident in the last couple of weeks as well as we've seen how the market moves. So this is why we always say time in the market is more important than timing the market. Now, what is the difference between these two sentences, right? What is the difference between timing the market and what's the difference between timing the market? Now, time in the market is actually the amount of time you spend in the market. So through all the ups and downs, the volatilities, you still continue to stay invested. That's time in the market. Basically, you're spending time in the market, right? And you're also dollar cost averaging through all the volatility. Timing the market is what I mentioned earlier on. You're trying to find the best time to enter, the best time to sell. I don't want to buy today because, I don't want to be catching a falling knife. Market rebounds tomorrow. Oh, I think market is too high now. I'll wait for it when it's lower. So this is when, you kind of also get into some sort of emotional stress. So we highly recommend you prioritize time in the market versus time in the market. Now, why is timing the market so tough in general? In fact, why is it also virtually impossible? It's because one, the worst and best days are actually very close together. So as an example, what we saw last week, right? We saw days of declines and then overnight the market went back up. No one could have predicted that. Two, ignoring the noise we see in the market every day, headlines, news portals, any sort of articles that we're reading, it's actually very distracting. And if you look at this picture here, it's a graph of events and happenings over 30 years from 1990 to 2020. So every day there's volatility. Every day there's volatility. But then when you zoom out, markets always trend outwards, right? So, we started 1990 low, we touch a high, markets potentially retreated. And then there's obviously a lot of noise on a daily basis, different headlines. But then every time it rebounded, it always touched a higher high. So despite any declines, markets have statistically 100% of the time recovered. We just don't know the timeline, but it has always recovered. And as the title of my slide says, if we had actually chosen to listen to all the noise in the media, I think we would have stayed out of the market, right? But what would, staying out of the market or trying to time the market actually have cost us? So let's have a look at this. If you had invested $10,000 in the S&P 500 index fund and kept it there for 20 years through all the ups and downs, right? At the end of 20 years, your portfolio would be around $64,000. That's 10K to 64,000. You haven't touched it. You just left it there for 20 years. Through all the ups and downs, you just left 10K in the markets for 20 years. However, if perhaps, there was one day there was a huge downturn, you were spooked, you decided to withdraw, and then you decide to invest when market quote unquote recovered. So you missed out on, say, 10 best days of market over the course of 20 years. So that's 10 days out of 7,300 days, right? 10 out of 7,300 days, you would have missed out on 35,000 worth of gains. Now, what if you had missed 40 days? That's 40 days out of 7,300 days. You would have missed out on 56,000 worth of gains. So what does this all mean? Now, finding the key to successful investing is not finding the perfect entry or exit point. It is being consistent and staying invested in the markets through all the ups and downs. I think whenever someone asks us when's the best time to invest, is today a good time to invest? We always say it's always a good time to invest, and we actually believe that because as we see in the chart later, earlier on, when you zoom out through all the volatility, markets have always trend upwards, and markets have always recovered. So if you have patience and you keep a long-term mindset, you'd be able to stomach much of the storms that we will go through in our investing lifetime. Now, let's look at the difference between what it means to be trading and what it means to be investing. I think there's people often get this two kind of mixed up, right? Trading is relatively short-term focus. We're talking hours, days, months, weeks, the constant entry and exit, right? And this also builds up your transaction costs. And as a trader, you constantly also have to sit in front of your screen and watch the market. So it requires a level of attention. And if you had missed a good trade, or you executed a bad trade, it could also affect you emotionally. On the flip side, when we have investing, and when we invest, it focuses you more on the long-term horizon. So we're talking years, potentially decades, to achieve a financial goal like retirement, or big goals like buying a house, right? It's also generally lower in costs because you're obviously not exiting and entering as much, so it's lower transaction volume. And at the same time, by staying invested, by being very disciplined and dollar cost averaging in through all the market's ups and downs, compounding works in your favor. That's very, very important. Compounding really, really works in your favor. Now, over here, you see two charts illustrating the differences, right? I hope it's illustrated clear enough. But with trading, you may only be capturing a fraction of the potential of a specific asset. So yes, you make some money, but you're only capturing a fraction of the potential. But with investing, you're in it for the long haul. And ultimately, you end up with a lot more than when you started. So keep these two things in mind, right? The difference between trading and investing. Investing, take a very, very disciplined approach. If you like to trade, that could be part of your satellite portfolio, but you have to be very disciplined about it. And you have to make sure that you're constantly watching the market and just don't let it affect you too much. Now, I've spoken a lot about diversification, and also about why it's important. So to put it rather simply, it's all about either winning big or winning consistently. So as an example, what you see on your screen are two graphs. So the first one in dark blue here is Boeing, one of the largest airplane manufacturers, in the world. Now, if you had invested in Boeing, you would you would have gone through much volatility, right? But you would have some wins when the stock basically recovers and swings up. The line in black is XTN, which is an ETF that actually gives you exposure to 40 to 50 of the largest transportation companies, including UPS, very big names, FedEx, Uber, Delta, Hertz, and some maritime companies. So it's extremely diversified across different segments within a specific industry, which is transportation, right? Now, look at the performance versus if you had just taken a loan position in Boeing. What does this mean? Diversifying, especially into an ETF, helps you to reduce your risk and gives you a much broader exposure. Sorry, excuse me, which then helps to balance out the risk and volatility. And most importantly, it helps provide you with consistent steady returns. So that's what you see through all the volatility. The different sectors actually helps you balance out the risks or the downside that one specific, say for example, company or segment may actually be experiencing. So that's why it's so important for you to actually be diversified, right? So that's why we also do encourage you to diversify across asset classes as well, right? Because generally when, for example, if equities were to go up, or if equities were to be coming down, bonds usually hold a lot steadier, or they may actually even increase slightly. So that's why it's important for you to have all these balancing assets just to make sure that your portfolio does not experience large swings, especially when market is extremely volatile. Okay, now, if you ask me, May, when is the best time to start investing? I would say the best time was yesterday, but the second best time to invest is today. It's never too late to start investing. The only thing is that the later you start investing, the more you have to set aside to achieve your goals. Now, looking at this title, If you want to retire at 65 with $1 million, it is achievable. It just depends on where you are currently in life. Now, sorry, excuse me. If you had started at age 25, setting aside $470 a month to invest in something that gives you a conservative return of 6%, it can get you to that 1 million mark at 65. However, if you start later, at say 45, you'd have to set aside about 2,000 every month. Now, the important thing is that you start. But once you start, to be disciplined, dollar cost average, and don't stop. Now, regardless of your circumstance, all you need, I think the key point that we want to sort of drive through and share with everyone today is that the most important thing is that you start. And when you start, just don't stop. So as an example, if you had decided, you know what, I'm going to start today, I'm going to be setting aside $1,000 every month into, say, portfolio A, and that's the plan for, the next 10, 20 years. The next month rolls around, you have some unexpected expenses. And unfortunately, you're only able to invest, say, $500 today. That's okay. Don't neglect your portfolio. Put in that $500 because every amount counts, and compounding will essentially work in your favor the more and the longer you actually invest. So that's why it's so important. And again, the one thing I want to share is that it's not too late for you to start investing. The most important thing that you can do for yourself today is to start investing. Now, before I share key takeaways from today, I actually want to briefly touch on thematic investing and what it means. Now, thematics is essentially us using targeted ETFs to capture certain trends. So as an example, let's say you're someone who is super bullish on AI, maybe blockchain, and you want to gain some exposure to the sector. Where do you start? Do you sit down? Do you look through company reports to figure out what's the best AI company out there right now? What potentially is the best blockchain company out there right now, and you slowly pick individual stocks to form a portfolio. Generally, how would you know which is the best to gain exposure to the sector, right? Where do you start? So that's where thematic ETFs comes in, right? It's managed by fund managers. And by investing in one ETF, you get exposure to a whole sector. You get exposure to potential high growth companies in the industry, and it helps to enhance your portfolio beyond broad market returns. This also allows you to invest in sectors that you're personally interested in. So as an example, I gave two examples, AI and blockchain earlier on, but let's say you're super bullish on healthcare, right? You think, it's going through a renaissance, something will happen, something good will come out of it. But you just don't know where to start. So there are a lot of healthcare ETFs out there, including some on our platform, if that's something that you're interested in. So that's one way for you to gain exposure to the specific sector without having to do too much cognitive work, right? If you recall my sharing of core and satellite strategies and portfolios earlier on, it should ideally be 20 to 30% of your overall portfolio. And it's mainly a complement to your main holdings. So as I mentioned, your main holdings should be, potentially low cost ETFs, something that gives you extremely broad market exposure, something that you think you can hold for a longer period, potentially dividend yielding stocks. But for thematics, that can form your satellite portfolio. The reason it's also higher in risk, and the reason why it's part of the satellite, not part of the core, is because some of these themes are actually quite nascent. They're quite young. So as an example, right now, the hot theme is obviously AI. But then what's going to happen with AI in the next 5-10 years? We don't know, right? So that's why it's super high risk, and that's why the holding period is also a lot longer. Usually for S&P ETFs, you've seen historical returns. It's you generally can be confident that at least in the next 3 to 5 years it will recover, but we don't really know what will happen with industry-specific ETFs. So you might experience more volatility in the next, say, 3 to 5 years. So that's why the holding period is generally a lot longer. You need to have a longer holding period for thematic ETFs. And it's also really, really important for you to remember to not just invest in one specific theme. Definitely diversify across multiple themes. Give yourself the edge of having the power of diversification. Now, these are the benefits of investing in themes via ETFs, sorry, as I've mentioned earlier. Last week, I talked about how we should leverage tech to our advantage, and I still strongly believe that we all should leverage technology, especially in the 21st century and especially in today's day and age, to our advantage, and invest in managed portfolios through digital wealth platforms or any sort of other sort of opportunities that you may have. Today, I'm encouraging to take advantage of the availability of ETFs at our fingertips and use them as one of the main vehicles for you to gain exposure into the market. As I mentioned, the benefits is that they're lower in costs. So fees are definitely something that we should pay attention to. It's usually already, it gives you diversification. So it's usually already, when you buy one ETF, you have exposure to multiple sectors, segments. So it helps you take the load off deciding, which company I should pick. And thirdly, obviously with the power of diversification, you can definitely, you're able to manage the risk of your portfolio in a much, much more stable manner. Now, just doing a quick time check, okay. We'll have time at the end for some questions. So just as a reminder, please feel free to use the Q&A chat function if you're on Zoom. If you're on YouTube, please feel free to use the chat box function, right? We'll get to them shortly. Now, before I end, 4 key takeaways from today's session. Number 1, make sure you know what your risk tolerance is. As I mentioned, the difference between risk appetite and risk tolerance. Risk appetite is I'm willing to take risks. Risk tolerance is I think I can take risks, but I also don't like it when my portfolio is potentially down 10%. So maybe I'm not that much of a risk taker anyway. So risk tolerance is obviously more important, right? Second thing is build a diversified portfolio using ETFs. So you get broader market exposure, you get that diversification you need, and you ensure that you keep your costs low because, every penny you save is an extra penny invested in the market. And that's very, very important because then compounding can work in your favor. The third is to stay invested through all the ups and downs. So as I mentioned, time in the market is way more important than timing the market. So don't try to time the market. It's, make sure that you stay invested through all the ups and downs, your dollar cost average. Make sure you're also investing in fundamentally sound assets. That's what's very, very important. Fourth thing for everyone to explore today is using thematic ETFs to gain exposure to high growth markets and trends. Save yourself the headache of sitting down tonight, going through multiple company reports, multiple fact sheets, deciding on which company would be best for you to gain exposure to a specific sector. Go on Stashaway's platform. We have the flexible portfolios. We already have a curated list of specific ETFs for specific sectors. These are well KYC'd, to lack of a better way to describe it, by our investment team. So we ensure that we only give you the best of the best at the lowest cost possible. So I mean, the long shot of it is use thematic ETFs to gain exposure to high growth markets and trends, right? I think that's what's most important. Now, to get you started, we actually have a promo code for everyone here tonight. Same promo code if you were here last week, but essentially, if you're already a user, scan this, it will automatically apply to your account. Your next 50,000 will be managed for free for 3 months. If you're new to the platform, don't worry. Just remember the code is MYF 2025. Sign up for our account today. If you're in Singapore, it's very easy. Just use SingPass. If you're anywhere else, just basically, you can also sign up to Stashaway, and the code is MYF 2025. Use that, and your next 50,000 will be managed for free. It's activated upon your next deposit. And this doesn't mean you have to deposit 50,000 straight to be eligible. Yeah, it can actually be over the course of the next, I believe, 3 months, when this code expires. So you can put, 1,000 today, try it out. If you like it, maybe another 1,000 next week. And then it's basically it accumulates, right? So that's it for today. As I mentioned, we have time right now for Q&A. So, if there's any question you may have about portfolio products, please feel free to drop it in the box. If you have anything that's a little bit more personal, in a sense where you're currently a client, you have questions about your specific portfolio, I would encourage you to actually reach out to support@stashaway.com instead. We're happy to jump on a call with you and just kind of run you through your specific portfolio question, right? Because I think that will be most useful rather than just a general answer. Okay. First question, what is the cost incurred from Stashaway? What is the cost incurred from Stashaway for investing in ETFs? Okay, so any sort of as in the cost we pay, I imagine. Any sort of rebate, let me just share, any sort of rebate that we actually get from the fund managers that we actually give it back to our clients. So the cost on our end is really just, I guess, transaction costs when we actually buy the ETFs for you. But then as the end client, the cost for you is very low. It's anywhere from 0.2% per annum to 0.8%, depending on your AUM. So it's a sliding scale. The higher the AUM, the lower your costs. With this promo code, it's free for the next $50,000. As I mentioned earlier on, you can also sort of build your own portfolio using flexible portfolios. Let me just kind of go back to one of the slides where I show. Yep. So if you see here on your screen, um, here, custom. I don't know if you can see my cursor, but at the bottom, custom flexible portfolios. That's where you can also build your own ETF portfolio. If you just choose to invest in one ETF, it's 0.3% per annum, not per transaction. So what that essentially means is, let's say I decide I want to invest in the S&P 500, which we actually have on our platform. And you can also use your SRS funds to invest. That's actually something that is very, very key and and important information that not a lot of people know as well. But essentially, if you were to invest in the S&P 500 today, you were to build a flexible portfolio with the S&P 500. No matter how much transactions you make, you're only paying 0.3% per annum. And if you actually built like a portfolio with different ETFs, then you fall within the whole 0.2 to 0.8%, depending on your overall portfolio AUM. So I hope that actually answers your question. Okay, so what potential impact could Trump's proposed sweeping tariffs and other possible policy changes have on choosing and returns from ETFs? Okay, so I'm assuming this question means what I'm taking away, the meaning of this question is what could the proposed tariffs actually, how will it affect the market, right? And ETFs. I think generally it's a little bit hard to predict because with this gentleman, we don't really know what he's thinking. And tonight he could announce something different actually. Tomorrow market could react very, very differently. What we would suggest actually is to have a very diversified portfolio to make sure that you're not just solely invested in US equities. And as an example, that you're invested in broad market ETFs. That's one thing. And at the same time, you don't just have exposure to equities, as an example, via ETFs in your portfolio, that you also have other balancing assets like bonds as well as commodities. As an example, gold is actually doing very well in the current climate. So I think the most important thing is that we will be going through a volatile period. There will be a lot of ups and downs, especially given that there's a lot of uncertainty up in the air. But the key thing is to actually stay invested, be disciplined about it. Don't look, because as I mentioned, markets have always recovered. We just don't have a timeline, obviously. So stay invested. If you can, dollar cost average in. At the same time, make sure that you actually have a diversified portfolio so that you're able to hedge, the risk, number one, and the volatility of, the different assets and how the different assets may actually move against each other. So yeah, I hope that actually answers your question. Okay, next question. Is it recommended to invest, example, low and medium risk in stash away for diversified purpose? Yes, absolutely. Because even between the low and medium risk, your asset mix will be a little bit different. So if you actually have the capacity and the ability to invest in two different portfolios, by all means, do actually invest in multiple different risk portfolios. So as an example, I can share. I'm someone who I like to take a little bit more risks. And I'm comfortable with that. So I actually have super high risk portfolios, and I also have medium risk portfolios, and I actually have some self-built flexible portfolios with multiple ETFs in it. So it is worthwhile actually exploring different risk portfolios for diversification, because as I mentioned, there will be overlapping assets, but between the different risk portfolios, there will also be slightly different asset mixes in addition to the overlapping assets. So absolutely, you should actually, if you can, obviously invest in different risk portfolios just for diversification purposes. Thank you for that question. It's a really good question. Okay, other than a common ETF like S&P 500, VU, Spider. Are there good recommendations of other ETFs? I would suggest you look on Stashaway's flexible portfolio. That's where we actually have all our sort of recommended ETFs and ETFs that we actually think are a good way for you to gain exposure to certain sectors. It's again not investment advice. There are a lot of different ETFs on the portfolio. We have Nasdaq, we have Dow. Allow you to have exposure to Japan equities, India equities, uranium, gold, bonds, certain bonds. So yes, there are a lot of good ETFs out there. I think that the key is how do I actually pick the ETFs. So, as I mentioned, I would encourage you to look at our flexible portfolios. Those are the ETFs that our investment team has actually specially curated for our users. They've done all the due diligence, they've done the work for you, right? And all you have to do is just decide, am I comfortable or am I, say, for example, today I am super, super bullish on just a wild example, just an example, India, right? But I don't know where to start. Okay, we have an ETF ready for you. Just create your flex portfolio, and then deposit your money, and we'll invest and we'll do the rest for you, right? So the goal is you do life, we invest for you. Yeah. So to answer your question, there are a lot of good recommendations. Just check out our flex portfolio. You would see our whole list of ETFs there. Okay, next question. Do you DCA in your ETF when the price is higher than your average? Sorry, do you DCA in your ETF when the price is higher than your current average holding cost, or do you wait till the price drop below your current cost? I DCA regardless of whether it's, for me personally, I DCA regardless of whether it's higher or whether it's lower, because my goal is really accumulation at this point. And if market drops and it so happens I'm DCAing, I buy more. If the price is higher than where my cost currently is, I potentially buy a bit less. But then, in the long run, I think my cost will average out to be much lower than the market price just because I'm buying through regardless of the market's ups and downs. So it's all about taking a more disciplined approach when you invest. So regardless of market highs or market lows, you'll just consistently buy in because I also know that I am investing for the long run. And I know that, the whatever portfolio I have, I want to be able to retire comfortably as well in the next 20, 30 years, hopefully. So yeah, regardless of ups and downs, I still DCA, and it's a very disciplined approach to investing, and it's one of the key things that we wholeheartedly believe is one of the essence of successful long-term investing. So yes, regardless of whether markets are ups and downs, I still DCA in, and we would highly encourage you to also DCA in. Okay, I am checking out the custom flex portfolios. I'm thinking, should I include S&P and gold together or separate them in two different portfolios? It's obviously, if you put it together, you would help. Their assets on basically where they are both on different ends of the risk spectrum to a certain extent. One is, gold commodity is safe haven. It's done very well in the last couple of years. Through all the volatility, it's held up really strong. If not, it's rising. S&P 500, on the other hand, is on the other end of the spectrum. Oops, sorry, where it's full exposure to equities, where it's a lot riskier. Super, super volatile, obviously. So having them in the same portfolio helps you to sort of balance the risk a little bit. If that's what you're looking for, by all means, go ahead. But if you're willing to say, hey, I want maximum gains, I'm okay to take the risk, then you can just create a portfolio with S&P 500. If you feel like, okay, I want gold just for a steady sort of return that hopefully, I know that this funds I need it, say in the next maybe 12 months, maybe you can consider gold because it's a lot steadier. But, the money that you put in the S&P 500, perhaps, it's something that you need. It's money that you potentially don't need for the next maybe 6 months, 12 months. Because obviously markets move in different directions. And in the next 6 to 12 months, market could move against you and you might not have the capital that you need when the ones that you put in the S&P 500. So the funds you put in the S&P 500 maybe are funds that you potentially don't need in the next 3 to 5 years. For the funds that you put in gold, maybe it's funds that you need in the next 6 to 12 months because it's a lot steadier, it's a lot safer. But obviously if you put them together, it helps balance the portfolio a little bit more. So it really depends on what you want. And it really depends on how much, again, risk that you're willing to stomach. And also, if you put it in flex, you're able to adjust the weightage. So if you want it to say, for example, you're like, okay, you know what? I want it to be in the same portfolio because I want them to sort of balance each other out. I don't want to see too much of a wild swing. You can put it together and you can also say that, but I do still want slightly higher exposure to equities. Then you can set the weightage of the S&P 500 to say, I don't know, 60, 70, 80%, and the weightage of your gold exposure to, the remaining of whatever that percentage is. So, feel free to kind of play around with that number, find a number you're comfortable with. But then again, depending on circumstance, if it's funds that you don't need for the next 3 to 5 years, maybe you can take higher risk. You can look at put it in equities. If it's funds that you maybe need in the next 6 to 12 months, maybe put it in, safer, steadier asset. But ultimately, again, it's a very general answer, the one I'm giving. Depends on your circumstance. If you have more specific questions, please feel free to reach out to support@stashaway.com. Yep, so I hope that was helpful. All right, we still have time. Do you recommend to invest in China or Japan for portfolio at this point in time? So I think generally, as I mentioned, there's a lot of uncertainty in the markets. China and Japan are the two biggest economies in the world. It's hard to ignore it. But ultimately, I think for various reasons, this is a house view, both economies have potential. But again, as I mentioned, it will be very, very volatile. It again depends on your circumstance. If you're willing to take the risk, please do explore investing in either of these, hopefully through ETFs on our platform. And if you feel like, I am willing and I have the holding, I'm able to hold, this portfolio for the next 3 to 5 years, by all means, please explore. But as I told the person who asked the question earlier on, if these are funds that you need in the next 6 to 12 months, perhaps, do not just invest solely in China and Japan. What you can potentially do is create a portfolio with China and gold, Japan and gold, or China bonds and gold, Japan bonds and gold, just to average everything out, so that you are able to hedge your risk and downside risk a lot better. But in my opinion, I think generally overall market, we're going to be going through a lot of volatility, at least in the next 3 to 6 months, with everything, that we see in the media. If you have the holding power, if you have the capacity to DCA in a very disciplined manner, then it should pay off, hopefully in the long run. So yeah, that would be my answer. Again, it's not investment advice. It's unique to your circumstance, but we're happy to take this conversation offline with you, because we also want to understand your circumstance. And we don't just want to blindly say it's a good investment for you. It really depends. It's not one size fits all, it's one size fits one. So please do reach out to support@stashaway.com. Our team will be more than happy to kind of walk you through the rationale and what you should really be thinking of before you actually take that step to invest. Okay. Kumar, yes, DCA. Yay, okay. So what happens when you need the monies and need to sell, but market is on a downward trend? Ooh, that's a tough one. If you need the money, you need the money, unfortunately. I don't have a good answer for that, but if you're able, perhaps you can start with, if market is on the downward trend, if there are areas where, or assets that you are already in the green, maybe you can start with selling that first and then slowly. But ultimately, I think the reality is if you need the money, you need the money. But the one thing I can share is that, say, for example, I know, okay, emergencies are a different thing, right? Like you just never know when you need your cash. But if you do, unfortunately, you have to sell. The one thing I just want to share, which is what I've actually been saying in the last couple of questions, is that if you know that you have, an expense coming up in the next 6 to 12 months, as an example, with whatever funds that you have allocated for this, perhaps don't invest in risky assets. Invest it in steadier, higher yield, but steady assets. So like bonds, money market funds, perhaps gold, something that is not as volatile, but also gives you steady growth. If you know that, hey, I'm saving up for a house in 5 years, if that's your goal, Maybe you can take a little bit more risk, and then whatever pool of money you have, then you invest in something a little bit riskier. So I think the important thing is also having a plan and know what your financial goals are. But Kumar, to answer your question, if unfortunately, if it's an emergency, you really need the money, but market is down, I think we'd have no choice, because for me as well, if I do need the cash, the market is down, you'd have no choice but to sell. But I would perhaps look for what is green first, and then I'll just sell, and take profit on that first, and I'll see if I can sort of stagger whatever payment I need to do. So that would be my life advice to a certain extent. But yeah, and I hope it's helpful. For a 25-year-old guy, what type of portfolio should I invest in, and what are the allocations if I can hold for 10 years? I think what's most important is, first of all, you're very young, which is great. Kudos to you for wanting to start early. Um, what I mentioned early on, which you should definitely keep in mind, is your risk tolerance. So make sure you know what kind of risk you can take. If you have no investing experience, I would suggest that you start with potentially the medium to low risk portfolios first. The lower to medium risk portfolios first, to sort of get an idea of how the market sort of works. And then from there, you'll be able to sort of understand a little bit more about your own investing personality. Because I think a lot of times when we start, we just want to make money, and we want to make it fast, and we want to make a lot of money. That's not entirely the right way, but just starting small in different portfolios, maybe across multiple risks, and then understanding what you're comfortable in, right? Because even though you're younger, it doesn't mean you're comfortable with risk. So perhaps, say for example, if start, let's say you created 3 portfolios, one in low risk, one in medium risk, one in a high risk section. And markets are moving the way it moves, and you see that, oh, I'm actually, whatever is happening in my high risk portfolio, I'm really not comfortable. But whatever's happening in my low and medium risk, I think I can still stomach it, and I'm willing to continue to DCA in. I have conviction. Then by all means, you already know that high risk investing is probably not your thing at this point in time. Maybe with more experience, you'll be a bit more comfortable. But at this point in time, maybe you're generally a little bit more comfortable with low to medium risk. So I would suggest that you start across multiple portfolios. We'll start with just a little bit of money. It doesn't have to be too much. I think the one misconception that we all have is that you need a lot of money to make a lot of money. That's not true. Starting small, understanding what your risk tolerance is, understanding what you're comfortable with, understanding what your general investing behavior is. I think that's most important. You're very, very young. I'm glad that you're thinking about starting. Yeah, so just try to explore first, see what you're comfortable with, and then with that, slowly pick up confidence, grow your confidence to potentially look to maybe creating your own portfolio with flexible, or maybe even, going into thematics. So yeah, start small, couple of portfolios, DCA in, understand the markets a little bit more, see what you're comfortable, and see what you're not comfortable with. That's probably one of the best ways for you to really learn about your investing personality. Very insightful. Thank you so much. Oh no, thanks for watching. I hope this was actually insightful. Will there be a session to touch on monsoons? Yes, actually, good question. So next week we are actually going to be talking. I'm going to be talking a little bit about income investing. So we're going to be talking a little bit about fixed income. If that's something that you're interested in actually watching, please stay tuned. I believe the invites have gone out, but let me just actually send the link to the event if you have not signed up. So next week, I'll actually be talking a little bit more about fixed income, where I'll touch a little bit on bonds, and how you can hopefully use bonds to build like a passive income for yourself. Just give me a moment. I will share the link to the Eventbrite. Okay, I've sent the Eventbrite to the chat box. Feel free to sign up. It's happening same time next Wednesday. So yeah. Yeah, so I hope that answers the question. So thanks, Kumar, and thank you everyone actually for joining. Yeah, I think it was a really, really good session. Once again, if you have any additional follow-up questions about the product, about the portfolio, about me, about the future Master Your Finances session, please feel free to reach out at support@stashaway.com. Once again, I hope this was helpful. We will be sending a feedback form after this. So please do me a favor and just respond. It really helps us know if this content it works for you, if there's any sort of other content that would be helpful for you as you embark on your investing journey. Yeah, so once again, thank you so much for your time and good night, everyone. Hopefully see you next week. Bye.